So we all go through different emotions during the day. Happy, sad, focused, grumpy. We're all very moody, and so is the stock market. In fact, picture this. So after going through the many videos on my channel, you found, let's say, what seems to you as the perfect stock. The company has high and consistent sales growth. The price earning ratio is low, a sunrise sector, it has a capable management, etc. But instead of delivering the 30-40% return you were hoping for, the stock price is presently nowhere near that number. I'm sure this kind of situation has happened to you as well. And while there is nothing wrong with that company, all this non performance was more to do with the depressed sentiments in the stock market. It's a bit like how Dhruv Rathi says it.
अंदर से एक फीलिंग आती है कि आज मूड नहीं कर रहा, इसे कल देखते हैं इस काम को।
तो ये जो मूड नहीं कर रहा है वाली बात है ना, it can be very dangerous for our investments, which is why in this video I want to talk about what exactly do we mean by market mood, what are the different variables that comprise of market sentiments, what does the data say. So I've done some independent study on it, and most importantly, how can we use this information to improve our investing decisions. Let's begin. All right, so the phrase market sentiment is simply the current attitude of investors towards a company, a sector, or the stock market in its entirety. A large part of this mood is affected by crowd psychology, that is, what is the majority thinking, feeling, and while this might sound a little fuzzy and subjective, thankfully there are a few scientific ways of understanding this. One of the more popular tools is CNN's Greed and Fear Index that uses a combination of factors, so things like market strength, volatility, put and call options, momentum, etc., to understand the general opinion and speculations of market participants and to get a read on the direction the market is likely to move on. In fact, CNN coming up with this index is pretty ironic because a big reason behind investor emotions and reactions is the influence of 24-hour news services, which is also known as the CNN effect. Anyway, specific to India, we have the Market Mood Index, which was initially introduced by Market Psych in 2004 as a survey-based tool, but over time this has evolved and it now incorporates more sophisticated data analysis methods and considers factors like economic indicators, corporate earnings reports, news events, market volatility, trade volume, social media activity, and much more. All these data points go into a complex algorithm, and what comes out is a single number that represents the overall mood of the market. Now, I'm sure many of you know this, but Tickertape has a market mood index on its platform. It's not the market psych version. I think it's their own methodology, and they use a combination of 6 different variables to come up with their own MMI number. For instance, at the time of recording this video, the MMI was at 73.3, indicating an environment of extreme greed amongst the market participants. Similarly, a point between 50 and 70 represents greed, 30 to 50 is a period of fear, and anything below 30 signifies extreme fear and potentially opens up buying opportunities. In that context, the Market Mood Index is an extremely useful tool to capture opportunities during a market rally or market crash. But you know what? One still needs money to invest, and the best way to increase one's income capacity is by landing a high paying job, which is by doing a full time MBA. However, traditional business programs lack practical and experiential learning outcomes, a problem that's now being addressed by new age business schools. Which brings me to the partners of today's video, the Bangalore-based Scalar School of Business that offers an 18-month full-time postgraduate management program that is designed by leaders who have built billion-dollar businesses like Uber, Myntra, and McKinsey. And because Scalar has been in the education industry for the past 7 years, they already have access to 1,200 plus company partners like Google, Amazon, Bain Capital, etc., something that no B school in the country can offer. For their online programs, they have seen placement rates of 96% and a median CTC of 25 lakhs that has been verified by B2K Analytics, which is the same partner that verifies reports for the IIMs. The program's founding cohort is launching at the end of August 2024, and there are scholarships up to 100% that one can avail. Applications for this breakthrough program are open now, and you can apply to it using the link in this video's description or the pinned comment. Alright, so the hypothesis is very straightforward. Extreme fear is a great time to buy, just fear is good. Greed is okay, but extreme greed is definitely a time when one should exercise caution. Now, I'm sure we can all appreciate the theory of it, but the real question is, does the market mood index work in a practical scenario? To test this out, I compiled the last 12 years of MMI data, and many thanks to Sachin for helping me out with the data dump. As I was not certain what to look for, I started with the most basic of inquiries: what happens if I were to invest only in the extreme fear phase, that is, when the MMI score is below 30. This came to 477 observations, which was 15% of the total universe. And as we can see from the table here, the Nifty had risen by almost 1% on an average over the next 10 sessions, with a 1-year index growth of 14.7%. So this is good information. But when I tried it in reverse, that is, when I simulated investing during periods of extreme greed, assuming that the returns would be really bad, it did come as a surprise when I found no visible difference in performance as compared to the extreme fear scenario. Honestly, this was a bit of a disappointment, but then maybe this data needs to be looked at in a different way, which led me to experiment number 2, and this was based on our tried and tested SIP format. So here's what I did. I transformed the daily information that Sachin gave me into monthly data, and I simulated a 10,000 rupee monthly SIP with one small variation, which is if the MMI on the day of SIP, so if this number was below 30, then I would double my investment from 10,000 to 20,000 rupees for that month. And if the MMI was over 70, which is the zone of extreme greed, then I'll pause that SIP, keeping the investment at 0 rupees for that month. So essentially it's 20,000, 10, 10 and 0 across our 4 MMI bands. And when I tried this over a 12-year period, so April 2012 until the first week of July this year, I received an XIRR of 14.2%. Alright, I have to confess I was a bit contented with this number, but when I backtracked to see what a regular 10,000 rupee SIP would have done over the same time period, I was a bit startled to see that not doing all this mumbo jumbo would have still given me an annualized return of 14.1%. I even went on to try different combinations. I tried a 30, 20, 10, 0, which definitely increased my absolute corpus, although the XIRR remained the same. Likewise, I tried a redemption strategy, something like a 20, 10, 0 and a minus 10. But again, the XIRR, well, you know what? I've had this XIRR issue once before when I made the video on SIP plus lump sum. So here's what I'll do. I'll leave this data, this worksheet with all of you. It's pinned in the video's description. And I'll encourage you to try out different SIP or lump sum variations and see for yourself if something makes more sense than the other. Okay, so by now I was totally frustrated with this market mood index. Honestly, I was ready to shut down the laptop saying इसमें कुछ मिलने वाला नहीं है, but that outlook changed a bit when I tried experiment number 3, wherein I examined the performance of MMI based entry points over different time periods. So what I did is I picked the month closing values from March 2012 until June of this year, and assuming we did the investment on that day, I mapped the future performance of those months on a 3-month, 6-month, 1-year, 2-year, even a 5-year basis. Essentially, I was trying to see if investing during the extreme fear stage was a better proposition as compared to an extreme greed one. ये मुझे पहले कर लेना चाहिए था, but चलो अभी कर लिया. Now, the output of this is pretty interesting, and on a short-term basis, so on a 3, 6, 9 and 12-month basis, investing when the MMI is less than 30 historically offers a much better result as compared to investing in any of the other bands. The way I look at this information is that if you have lump sum money to invest for a short duration, then you can consider using MMI and play the probability game. For instance, on the 0 to 30 band, I found 23 observations for which I mapped the 1-year return. Now, out of 23, negative values were seen on just 2 occasions, implying a less than 10% chance of losing one's capital, while a return probability of 12% or more was seen 60% of the times. Again, all this is probability, but when I did the same exercise, for all 4 MMI bands, extreme fear gave me the best odds with the fewest negative return chances over a 1-year period, and also the best opportunity for me to make over 12% in returns. So this data set is definitely useful when investing over a shorter duration, but when I populated the value over longer periods, 2 years, 3 years, up to 5 years, the variability in performance went down drastically. I mean, look at the 10-year return across bands. It's a difference range of just 1%, which essentially tells us the longer you stay invested in the market, the less important your entry point becomes, which consequently means you don't need to go deep into market sentiments. Alright, so this was a quick data study using the market mood index, but that's not the only way of assessing market sentiments or where the market might be heading. In fact, there are quite a number of techniques, so let's do a quick overview on a few of them. So first up are the momentum indicators, and one of the more popular tools is Relative Strength Index RSI, on which I already have a video on my channel. Essentially, RSI measures the strength and speed of price movement on a 100-point scale, which helps us identify if the market is overbought or oversold. In numbers, if the RSI is below 30, then the stock market is deemed to be oversold and there's a high chance of the market rebounding from there. Similarly, if the RSI value goes over 70, which is the case now, means that the index is overbought and one can expect some weakness in the market leading to some sort of correction. Similar to RSI, there are other momentum indicators like the MACD and the stochastic oscillators, which are equally helpful in analyzing the mood of the market. A second category of sentiment tools are the market breadth indicators, which is simply an analysis of the companies whose stock price is advancing relative to the declining ones. Now, there are two main parts to calculating the market breadth. Step 1 is the AD ratio, the advanced decline ratio, which is calculated by dividing the number of stocks that have gone up by the count of stocks whose price has declined. And step 2 is to find the AD volume ratio, which is the total trading volume of stocks that have gone up divided by the volume of stocks that have gone down. Dividing the AD ratio by the AD volume gives us the ARMS index, and if this number is low, so less than 1, then it gives out a bullish signal, and even otherwise, the market's mood tends to be positive when most stocks are on an upward trajectory and if this movement is supported by good trading volumes. So that's where this ratio is really helpful. Yet another sentiment market is the put-call ratio, which is calculated either on the basis of options trading volume or using the open interest for a particular period. It's a bit technical, so I'll suggest you read up more on this, but principally, if this ratio is more than 1, then it means more puts have been traded during the day, indicating a bearish sentiment amongst market participants. Another popular and prominent category of signaling tools are the technical indicators that offer helpful insights into market sentiments by visually representing the behavior and psychology of buyers and sellers. Chart patterns like head and shoulder, the double top bottom, etc. are established indicators, as are candlestick patterns like doji, the hammer and hanging man, etc. Again, I'm not getting into specifics here because charting and stuff like this is something I don't understand. But for your assistance, I've included a number of resources in the description of this video, so do check that out. Outside of technicals, market sentiments can also be measured via economic indicators like the CCI, the Consumer Confidence Index, retail sales, industrial production, purchasing managers index, the level of capital expenditure by private companies, and so on. Yet another growing field of mood analysis is media, or rather social media sentiment analysis, where complex algorithms are used to analyze the tone of media coverage on stocks and the market in general, in addition to an examination of social media platforms like Facebook, YouTube, X, Reddit, etc. So come to look at it, a single metric is not sufficient for us to understand where the market is headed, but by adopting a few of these signals discussed in this video and observing them over time can certainly offer valuable insights into the emotional state of market participants within the Indian market. Although not rigorously, I have myself started using some of these things that we have discussed today, and yes, if not anything, it definitely helps in building confidence in one's decision making. The market mood index is just one example, so do try out different combinations. And if you find something worthy, if some of your research can be converted into a video, then please email me the details using this email ID. Once again, thank you for your time. Do check out the resources I've compiled. Subscribe to my channel, my newsletter. Do like this video, share it with your friends, and I'll see you very soon. Until then.